Hi, John and Mary. Thank you for joining us today, and thank you for sending all of the documents and statements that we requested. We've had a chance to review everything and have put a comprehensive plan together, which we would give to you at the end of this presentation. Today, we'd like to touch on the most important aspects, and you can always reference back to the plan for more details. First, we'd like to review the scope of the engagement. You contracted us to prepare a comprehensive financial plan that looked at different aspects of your financial life. The purpose of the plan was to provide a framework for helping you reach your financial goals and objectives. The plan consists of a section for financial health, risk management, investment planning, retirement planning, tax planning, and estate planning. And the plan concludes with an action plan that identifies the most important actions and provides an implementation time frame for those actions. Before we get into your plan, we'd like to review the goals that you outlined. You identified four specific goals that to be considered when creating your plan. First and foremost was reducing any estate and gift tax liability and ensure all your estate planning documents are in order. Second, you wanted to review your current insurance contracts and discuss the implications of purchasing long term care policies. You wanted to reduce your personal income taxes as much as possible and have a portfolio created based on your risk tolerance that is diversified and is positioned to meet your investment needs and expectations. To build your portfolio, you performed a risk assessment. That assessment identified you as having above average risk, and so we built a portfolio around that. Given the fact that you have a high risk tolerance and the fact that you have a high capacity for risk, the portfolio we identified will be fairly aggressive. Additionally, you told us that you wanted to avoid investing in tobacco stocks, and that's something we can certainly implement within your investment policy statement. Now, we'd like to go over some of the assumptions that the plan is working under. If reality differs from the assumptions that we use, then the result of your plan will differ as well. Currently, you are in the highest marginal federal tax bracket, and we expect that to be the case for the foreseeable future. That means you will be taxed at 37% federal tax. You will also be subject to a 7% New Jersey state tax. You have a combined tax bracket of 44%. Currently, inflation is 2.25%, and the risk free rate of return is 1%. The market risk premium is currently 7%, and the expected return for equities is 8%. However, you do expect that inflation and interest rates will increase over the life of your plan. Now that we've gone over the basics, let's get into some of the recommendations. We did an examination of your current financial health, which does look in pretty good shape. There are some things to tackle, and we'll go over those now. Your net worth is pretty healthy and it's almost 13 million. Additionally, your net disposable income is about 1.3 million. Together, these put you in a good position to reach your financial goals. We reviewed some of your financial ratios, and two of them stuck out. One was your current ratio, which was well above what we would like to see. You had a current ratio of 41.14, and the benchmark for that is between 1 and 2. This means that you have more you have more short-term assets on hand than what you may need. Next, to confirm this, we looked at your liquid assets. Currently, you do not have enough liquid assets to meet your liquidity needs over the next 6 months, and this is something that you should address. To address it, you will need to increase your emergency fund by $184,434.50. We suggest using the proceeds from John's maturing CDs to fund this account. We then looked at the current debt that you have. You only have credit card debt and debt on the vacation property. You mentioned that you intend to pay off the credit card at the end of the month, so we're not too concerned about that, but that was factored into your liquidity needs. The house on the vacation property also isn't too bad. The mortgage on the vacation property also isn't too bad, and we will address that momentarily. Now, what we do recommend is investing some of the proceeds from John's CD. He has $800,000 in CDs, and as these mature, we recommend that you use these proceeds to meet some of your objectives. One such way you can use those proceeds is to establish 529 plans for Eugene and Beth. 529 plans are a great way to fund college education as the plans grow tax deferred, and in some states you can even get a tax deduction for contributing to their plans. 529 plans have a special feature, it's called the 5-year rule, where you can gift up to 5 times the normal estate gift tax exclusion amount, and that allows you to contribute up to $320,000 to their plans this year. To do this, you would have to elect to split the gift since the proceeds would be coming from John's CD. Otherwise, you could transfer half of the proceeds into Mary's name and Mary could then make the gift on her own. If you do decide to fund the 529 plans, then John, you will need to file gift tax form 709 by the gift tax deadline. And that would be the same as your tax filing deadline and is April 18th for 2023. Next, we look at the down payment from the installment sale of John's business. You received $1 million down payment, and we recommend investing this into your portfolio since you have excess cash from his CDs. We will create a dollar cost average approach to actually invest this into the portfolio. Dollar cost averaging is where you invest a fixed portion of the investment every period and you invest into the same funds. By doing so, you get to buy more shares of those funds when the funds are down and fewer shares when the price of the funds have increased. Over time, if the market is moving up and down and the price of those funds are moving up and down, you can create higher returns by doing this approach. It's a way to reduce what's known as market timing risk, which is the chance that you invest the full $1 million right at the top of the market and then it just goes down from there. Now, you may be wondering why we didn't recommend a 529 plan for Jack. The reason for that is he's currently 19 and we're working under the assumption that he'll be going through college soon or is currently in college. As such, you can actually pay his qualified college expenses out of pocket and you can pay it directly to the university. By doing so, you do not end up generating taxable gifts and it allows you to potentially gift more to him in the future. This is a more efficient way to pay for college if the time horizon is really short, since putting money into a 529 plan would be investing it into the market and there are downside risks to doing that. Finally, we suggest using a portion of the CD proceeds to pay off the remainder of the vacation mortgage. The reason for this is the mortgage interest rate is higher than the rate of CDs, and by paying off the mortgage, you can help improve your overall financial position and reduce the draw on your portfolio. Assuming there are no questions so far, we'll move on to a review of your insurance policies. Before we dive into those policies and dive into our analysis, we would like to let you know we have a conflict of interest pertaining to your insurance policies. We actually received a $1,333 fee from the agent that referred you to us in exchange for us referring your business back to him. If you would like, we can go into this in more detail. However, if not, we'll move forward now. The first thing we'd like to do is look at your property and casualty insurance policies. We reviewed your homeowner's policy and the dwelling coverage for your primary property is not enough in the event of a total loss. We recommend you reach out to your agent to increase that coverage. We currently project the replacement value of the property to be $775,000, and you would want your coverage to be that amount. Uh, we next looked at the vacation property, and that property also is not fully insured against in the event of a total loss, and you may want to increase that as well. It's not as urgent to increase your vacation property because you do meet the 80% coinsurance rate, which means that your policy coverage amount, which is $460,000, is at least 80% of the replacement value of your home, which is $550,000. However, if you do have a total loss, you are at risk of a $90,000 shortfall, which you would have to cover out of pocket. While you're talking to your agent, you should address this as well. After that, you can review your auto policy deductibles. The, you currently have a $350 comprehensive deductible and $500 collision deductible. You could increase both of these to $1,000 to potentially reduce the annual premium cost. This could help save money and offset some of the increases from raising your dwelling coverage. The next item we'd like to discuss is John's universal life insurance policy. With with the sale of the business, he does not necessarily need the full $2 million policy anymore. There's a few options that you could do instead of keeping the policy in force. One option is taking the cash surrender value. Now, the cash surrender value of the policy is $955,000. However, you would be subject to tax on the difference between the cash surrender value and what you've paid in premiums. Now, the tax cost of that will be about $161,000. So that's a pretty steep cost. An alternative to actually surrendering the policy is doing something called a 1035 exchange. This would be where you take the policy and you do a tax-free exchange of it into a different type of insurance policy. We would recommend exchanging it for a long-term care insurance policy, and the specific type of insurance policy would be what's known as a hybrid policy. By doing this, you use that cash surrender value that I mentioned, the $955,000, to create a pool of assets that John could use for long term care over his life. And any excess assets in the policy when he passes away would be distributed as a death benefit from the policy. So it's a good hybrid between long term care and life insurance. However, a con of this is that the policy benefit amount, $955,000, is probably more than he will need, and you could potentially receive a higher return by cashing it in and getting that surrender value. Additionally, Mary is unable to use this policy. So, an alternative to the 1035 exchange for covering your long term care needs is actually getting comprehensive insurance policies with a shared care rider. What this would do is provide a $360,000 benefit pool that you could each tap into to cover a long term care event. So, if John had an event, he could use up that entire pool. If Mary had an event, she could use the entire pool. If you both have an event, you can both tap into a piece of that pool. Now, the way that this policy would work is there's a $360,000 pool or 3 years worth of benefits, whichever comes first. Now, the benefit of this use of going with a long-term care policy like this is the premiums are tax deductible. However, you still do have those annual premiums. John's premium would be $6,400 a year and Mary's would be $5,000. So combined you would have $11,400 a year that you'd have to draw from the portfolio to cover these expenses. Adding that to the annual premium on John's universal life policy, and your total out of pocket cost would be around $40,000 if you kept the universal life policy and added the long term care policy. That's one of the big reasons we recommend going with the 1035 exchange if your agent finds that it's a good strategy to use. Something else we'd like to touch on briefly is your health insurance. You're currently covered under Medicare. However, we did not notice a Medicare supplement plan nor a Medicare Advantage plan. These are two different options to cover the gap in Medicare coverage, and we recommend reaching out to your agent to talk about this as well. And if you would like, we can even provide you the number for an insurance agent. Now that we've gone over that, let's go over your planning. There were a few issues we found with your current investment plan that we'd like to address. First and foremost, we'd like to address your stock portfolio. There's only four stocks in that portfolio, and they have not performed well relative to the market on a risk adjusted basis. Additionally, you bought the assets in the portfolio for $960,000. However, their current value is only $940,000. That means you have a $20,000 net loss on the positions. We recommend selling all four funds and harvesting the gains in stocks B, C, and D and offsetting those gains with the losses in stock A. As I mentioned, this would create a net loss of $20,000, which can be used to offset capital gains in other portions of your portfolio. And if you don't have any other capital gains, then it could be used to offset income, ordinary income of up to $3,000 per year, and the net amount would continue to carry over. So if you didn't have any capital gains this year, then you could use $3,000 to offset taxable income and have a $17,000 carry forward. However, we don't expect that to be the case because our other recommendation pertaining to your mutual fund portfolio is to sell out of the current taxable bonds in that portfolio and either move those bonds to your not to your qualified accounts, that would be your 401k or 403b, or switch those funds into municipal bonds if it makes sense. So we would have to run what's called a tax equivalent yield analysis to see if the taxable bonds are better than the municipal bonds. However, our preference would be to move those bonds out of your taxable accounts and into tax advantaged accounts. Again, your 401k or 403b. The main reason for this is the bond income is taxable to you as ordinary income, so you would be taxed at a rate of 44%. By moving the bonds to your IRAs, 401ks, and 403b, you can reduce the impact of the taxes. And the bonds would then grow tax deferred within those accounts. A second benefit is bonds tend to have lower expected returns. So the return on those specific accounts may be lower, and that would reduce your potential required minimum distributions in retirement and thus your taxable income on that front. We would then put high growth assets in your taxable account to take advantage of the tax treatment of long-term capital gains. Do you have any questions so far? If not, we'll move on to John's 401k. As I just mentioned, we would prefer to put the bonds in his 401k, and to do this, we would be selling out of the large cap blend fund that is in there. Now, before we make any of these moves with your actual investment allocations, we would we would create an investment policy statement for you. This statement would provide what we do invest in, what we don't invest in, your target. It would give a target asset allocation and expected return relative to inflation. And so all of that would be taken into account. Then we would create a plan for you to actually invest your assets. Speaking of which, we'd like to review that dollar cost averaging approach. We mentioned that we would do this for the down payment from the sale of John's business. However, we would not do this for the installment note receivable payments that you get. What we would do instead is, as those note payments are coming due each month, we would take the proceeds and invest those according to your asset allocation as well. It's not quite dollar cost averaging, but it accomplishes a similar feat considering you would invest the same amount every month. It's just a little bit different because we wouldn't have the whole $1 million the entire time. Finally, you did express a desire to avoid investing in tobacco stocks. We can definitely do this for you. We did want to note that avoiding certain asset classes or sectors of the economy can impact tracking error, and that's really the difference between your portfolio and what your benchmark portfolio says you're invested in. By deviating from what the benchmark is, your returns can also be different. So that's something to keep in mind when evaluating performance. So that covers your investment plan. And if there are no questions, we'll move on to your retirement plan. We reviewed your current financial situation and performed a retirement needs analysis, and everything looks in great shape. So good job with that. One of the items that we reviewed was your inflation adjusted return assumption. Currently, your inflation adjusted return is projected to be 5.623%. And if inflation differs from this, then that opens you up to potential risks of having enough assets. However, if inflation stays at the 2.25% that we project, then we expect you to have sufficient returns to compensate that risk. Something else we'd like to highlight is that because John earned $11,000 this year, it allows you to fund IRA accounts. What we would recommend doing is funding John's IRA with $7,000 and funding Mary's IRA with $4,000. We can do this due to a spousal IRA contribution rule, and each of these contributions would be designated as non-deductible contributions. That means that you do not get a tax deduction for contributing to the accounts. The reason that we recommend doing this is your income is too high to make deductible contributions, and your income's too high to make Roth IRA contributions. However, you can do a special feature called a backdoor Roth IRA conversion, and this is essentially like making a Roth IRA contribution. However, what you do is, as I stated a moment ago, you make the non-deductible contribution, and then you convert it over to a Roth IRA. Because you do not have any existing IRAs, or IRA balances, you can do this conversion without having any tax impact, assuming you don't invest the money in the meantime. Another thing we wanted to discuss is the potential of doing Roth conversions. So, Roth conversions would be the approach of taking your 401k, 403b, or IRA assets and converting them into the Roth form. What we would suggest doing is making those non deductible IRA contributions we just mentioned, doing that backdoor Roth IRA that we just mentioned, and then next year potentially roll over your 401k and 403b into IRAs in your own names. By doing this, it allows you to more easily perform Roth conversions. It also allows you to do something called qualified charitable distributions, which we will cover momentarily. An advantage of doing Roth conversions in IRAs is that a 401k requires you to take RMDs, or required minimum distributions, from the Roth balance within those accounts. However, IRAs do not have this provision, and that makes IRAs a bit more beneficial to actually do conversions. However, before we actually roll over the money, we would want to review the plan documents for your specific 401k and 403b to make sure there are no provisions within it that eliminate the benefit of rolling it over into an IRA. And we can help with that process. As I mentioned, another benefit of rolling the accounts to IRAs is using a qualified charitable distribution. What these are is it's an efficient way to get charitable contributions by using your IRA assets. A benefit of QCDs is, as I mentioned, tax you get a tax benefit by doing this because the donations to charity satisfy your RMD without generating taxable income. Additionally, you don't have to worry about itemizing your deductions to benefit from a QCD as you would with cash donations to charity or the donation of appreciated securities to charity. If there are no questions on this, then we will move forward with a review of your income tax planning. Again, you are currently in the highest marginal federal tax bracket, which is currently 37%. You're in the highest capital gains bracket as well, which is 20%, and you're subject to a 7% New Jersey state income tax. As we mentioned, we one way we can reduce your taxable income is by shifting your bond income from your taxable accounts to your tax deferred accounts. This would reduce the tax burden on any of that bond income coming from the mutual funds and reduce your overall tax burden. Additionally, we evaluated what to do with your 1918 Jenny inverted stamp. Currently, that stamp would be subject to collectibles tax rates, which is taxed at a higher rate than capital gain assets are. So we suggest you hold on to that until you pass away and allow your heirs to actually inherit the stamp and then sell it at that point. There are definitely risks to this approach, and it is not a slam dunk recommendation to do this, so we'd love to hear your feedback. Some of the risks of holding the stamp include the stamp not keeping up with the other assets in your portfolio. In that situation, if you had sold the stamp earlier and invested the proceeds into your portfolio, you could come out with a higher return in the long run. Again, it's not a slam dunk whether you should do this, but it is something to consider because selling the stamp would have a fairly high tax impact for you. Alternatively, you could consider selling the stamp later on in life when potentially your overall tax situation is better off than it is now. Any questions so far? If there are no questions, we'll move on to your itemization of your deductions. Currently, we do not think you can actually itemize this year, even though you made a $13,500 donation to charity. The reason being is your current itemized deductions are projected to be $25,500, whereas the standard deduction is $28,700. This means you lose out on those charitable donations from a tax perspective. This is another reason why we recommend doing qualified charitable donations. The last item we'd like to touch on is the establishment of a trust that provides you income during your lifetime and provides a charitable deduction the year the trust is made. One option to accomplish this is what's called a charitable remainder annuity trust. We suggest talking to a qualified estate attorney about setting one of these up and whether it is the best approach for your situation. However, if you do set up a charitable remainder annuity trust, otherwise known as a CRAT, then the way it would operate is the income from the CRAT assets would be distributed to you. The CRAT would create an annuity that would be distributed to you each year. The annuity payment would be fixed over both of your lives. It would be taxable. However, you do receive a present year tax deduction for the value of the donation going to charity at the end of the trust term. Again, an estate attorney could help you determine whether this is an appropriate strategy, but it is something we suggest you bring up. If there are no questions on that, then we'll move to your estate plan. This was one of your top goals, was reducing your estate and transfer taxes, as well as reviewing and updating your current estate documents. As such, we suggest you talk to an estate attorney as soon as you can. Some of the documents you'll want to go over with them are your existing wills, if you have some, your durable power of attorneys, your healthcare proxies, your advanced medical directives, your HIPAA release authorizations, and the establishment of any trusts that you would like in place. To do all of this, sorry about that. We recommend reaching out to an attorney so that they can get time to start setting this up. In the meantime, we highly recommend adding beneficiary designations to John's 401k and Mary your 403b account. This is something that we can help you with right after this meeting, and it's very quick and easy to take care of. A benefit to adding the beneficiary designations is it prevents those accounts from passing through probate, and it can help save you money on that front. Additionally, John expressed a desire to create two testamentary trusts through his will. An alternative approach to doing it through his will is first setting up revocable trusts in your own name, and then having those revocable trusts establish those testamentary trusts upon your passing. The benefit of revocable trusts is that they're an extension of yourself during your lifetime. So you can move assets in and out of the trusts as if you were to move assets between bank accounts within your own names. But a benefit of the trusts is it gives you increased flexibility to actually distribute the assets, and it allows you to remove any assets that are in the trust from your probate estate. However, revocable trusts do not remove assets from your gross estate, and they would be subject to estate taxes. Now, this is where that testamentary trust creation comes into play. So, the way that would work is you'd create two irrevocable trusts, and those trusts would get funded upon the passing of one of you. For instance, if John were to pass first, then he could create a general power of appointment trust for Mary that would distribute all income to her annually. The second trust that he would establish would be a bypass trust, and this trust would be funded with an exemption equivalent amount. What this means is whatever the estate tax exemption is currently would be put into that bypass trust upon John's death. This is a way to fully utilize that exemption and reduce the size of your overall estate and transfer taxes. Now, if there's any money above that, that is what would go into that general power of appointment trust in Mary's name. The way the bypass trust would work is you would establish it, and Mary could use that trust could use the income from the trust to cover health, education, maintenance, or support costs. Anything else would be excluded from her access, which would exclude it from her estate. Now, the trust upon Mary's passing would go to whomever is named in the trust document. On the other hand, the general power of appointment trust becomes assets of Mary's to do with what she wishes. This could be used to fund any expenses during her lifetime, and you would draw from these assets first, as they would be subject to estate taxes under her name. Is that clear? If so, we'll start moving on to a few other items we'd like to address. Primarily retitling assets to help avoid probate. Again, this is where those revocable trusts come into play. Some of the assets we suggest retitling are the vacation home, which is in John's name, the Chevy SUV, which is also in John's name, and the Chevy automobile, which is in Mary's name. Additionally, the 2019 Sea Ray boat and trailer in John's name, and the 1918 inverted Jenny stamp in John's name. we suggest you move these assets into those revocable trusts to remove them from your probate estate and avoid your overall cost of administering that estate. If that makes sense, we'll go over a brief review of actually implementing all of this and go over a prioritization action plan for you in the next few months. So, to recap everything we've just talked about, the items we'd like you to address in the next 6 months include funding your emergency fund with proceeds from John's CD and paying off Mary's credit card bill, finding an estate attorney to create your various documents, including revocable trusts, irrevocable trusts, and the CRAT if the attorney believes that is the right approach. At this time, we also suggest adding beneficiary designations to your 401k and Mary's 403b. We can actually help you with that after this meeting, as we mentioned, and it should only take a few moments to do this. We suggest you review your property and casualty insurance policies, including your homeowner's policy and your auto policy, as well as potentially an umbrella policy. Reviewing all of this with your insurance agent would be great to ensure that you are not at higher risk than you need to be. While talking to your agent, you can discuss performing a 1035 exchange and discuss acquiring long term care insurance policies if the 1035 exchange is not a great option. We recommend doing the consultation with your agent within the next couple of weeks so you can improve your insurance coverage as soon as possible and reduce your risk. Before the end of the year, we would recommend establishing IRAs in each of your names, making those contributions, 7,000 to John, 4,000 to Mary, and then performing backdoor Roth IRA conversions. We could help you with those backdoor Roth IRA conversions and could take care of that for you. However, funding of the account would be something that you would have to help us with. After the accounts are properly funded, we can look to actually roll over John's 401k and Mary, your 403b, into those new IRAs that were set up. We would want to wait to do this until at least 2023, so that way there is no tax impact for converting your IRAs into Roth IRAs. Now, before we do anything with your investments, we will work with you to create a asset allocation that will help you achieve your goals, something that has a fairly high level of risk with fairly aggressive growth given your risk tolerance. And we would also implement your investment policy statement and exclude tobacco companies from the realm of investments. After that is in place, we would look to start putting in your new investment plan, including selling the individual stocks and potentially selling the bond mutual fund in the mutual fund portfolio. We would coordinate both of these items with your tax advisor and you prior to completing them. Additionally, we suggest funding Eugene and Beth's 529 plans this year so you can benefit from that. So you can start the clock on that 5-year rule. Remember that 529 plans allow you to contribute 5 times the annual gift tax exclusion amount. And however, a con of that is if you were to pass away within those 5 years, then the funds would be clawed back into your gross estate and you wouldn't receive the same estate tax benefit of moving the assets into Eugene and Beth's name. Next, we'd like to discuss you should look at the CRAT. So if the estate attorney thinks a CRAT is a viable option to accomplish your goals, then you'd want to fund that this year ideally so you could get the present year tax deduction since 2022 will be the year in which your income is higher than any other year. This would potentially give you the biggest bang for your buck and make the largest impact. However, if that's not possible, then funding the CRAT in 2023 is also a good idea. During this time, we will work with you to invest the installment note down payment using the dollar cost average strategy we outlined earlier, as well as the installment note receivable payments that you get every month. Finally, once all of this is done, we'd start working on some of those other items we discussed. The above items are due by the end of the year, with the exception of your rolling over your 401k and 403b that we would tackle in 2023, but though the other list of items I discussed would be tackled in 2022 ideally. That way we can get you off on a good footing. Everything else we can start chipping away at over time, as they are not as critical of issues to discuss. Now, if you have any questions or any concerns over anything we discussed, or would like to look at things in more detail, we do have a full financial plan for you that you can certainly read through and look at, or we would be happy to set up another meeting to discuss this. And assuming you don't have any questions, then we'd love to work with you to get your 401k and 403b beneficiary designations fixed, so that way there's no issues there. And if you don't have any questions, then it was a pleasure meeting with you guys today, and we look forward to meeting you again soon. Thank you and have a great day.